If you just look at if you look at the last 10 or 15 years, U.S. financial assets have gotten 70% of the capital of the world. And so in order for them to continue to outperform or continue to be strong, they have to continue to get 70% of incremental capital. That is a lot of capital. That's a lot of capital sensitivity. We talk a lot about the trade sensitivity, but the reality is the U.S. has a capital sensitivity that is very, very elevated. And given the very high capital sensitivity, it won't take much of a withdrawal of that flood of liquidity to create pain in U.S. markets, and we may be just seeing the tip of that. I know that sounds like a pretty bearish view on things, but I think it's a risk not often discussed, and not even really discussed in the context of this trade war. Not really discussed at all in the context of this trade war, that if you're thinking about a longer term investment portfolio, you've got to start to think about, is that a dynamic that could be, meaningfully challenging to U.S. asset outperformance over an extended period of time?